There's a no-nos out there. The market's gone crazy and I'm here to tell you, don't do anything. Don't touch it. Don't do anything. You're not smarter than the market. Don't time things. Don't do anything. In this episode of Financial Dad, I'm here to show you 2 articles from CNBC that I find very helpful for investors like me and why you shouldn't do anything. So if you stick around, I'm going to guarantee your future self is going to thank you. And also, more importantly, I got a wicked dad joke for you. So without further ado, let's go Team Dads. Oh, I hit something. So the first article I want to talk to you about is from Sarah O'Brien, published March 2nd. The title is, Here's What Can Happen If You Flee the Stock Market for Cash. And the second article I want to talk to you about is from Pippa Stevens, published March 7th. And it's called, When You Sell During a Panic, You May Miss the Market's Best Days. Oh, we've seen some really crazy up and downs. So let's dive into the first article. Okay, so before we dive into the first article, I just want to allude to the fact that these 2 articles really talk about investors that I think has at least 10 years of investing. Someone like me who don't plan to retire for another 20 years, I think this is also very helpful. If you have less than 10 years, let me know. Do you find this article important? Because do you find it important? What are you doing? What's your investment strategy? I know your investment strategy is to hit the like button because this is the second night in a row that I'm trying to record this. How about subscribing? First article is, Here's What Can Happen If You Flee the Stock Market for Cash. Let's just start with how the article begins. And it says, if you're nervous about the stock market's nosedive and are considering moving to cash until you think the worst is past, you may want to think twice. Yep, right there resonates with me. I've been investing for a little over 3 years now. I've seen some ups and downs, right? But I don't track it. But this year, for some reason, I started tracking my portfolio more. And I'm trying my best not to do anything because I mainly buy ETFs. But it's made me nervous. And so right there, that first sentence, it really hit home that I need to think twice. And I have been thinking twice. So let's scroll down and let's take a look at that's the scenario they gave us, right? So you have $10,000 and it's $19.99 and you decide, you know what, Financial Dad, I'm going to do an awesome thing. I'm going to invest in an index fund of the S&P 500 and I'm going to take care of my future. And so you put in the $10,000 and you feel pretty cool, right? But then you go, hey, Financial Dad, no, I'm starting to have kids. I can't take care of this. So should I just leave it alone? Yeah, leave it alone. Just leave it alone. If you invest your $10,000 and you don't touch it, no touching, then you're going to have an average annual return of 5.6%. That's right. Over the 20-year period, you come out ahead. You almost triple up, right? You start with $10,000 and you're almost at $30,000. But if you think you're smarter than what's going on in the market and you think you can time things, that's where you're going to start feeling sorry. So if you miss some of the most awesome days in the S&P 500, let's just say the 10 best days, right? Then your return actually dips down to 2%. You're still making some money over the 20-year time span. So you go from $10,000 to $14,895. But you say, hey, you know what, Financial Dad? I get the hang of this investing, and so I'm going to play around with some more. And then all of a sudden, you miss another 10 awesome days. Well, now your return is in the negative. Yes, you're losing money. So you start off with $10,000, and now you're at $9,359. Does that sound good? Nope. But then you say, no, Financial Dad, you know what? I kind of messed up a little bit and I'm going to play around with it some more. And then all of a sudden, you're going to miss another 10 awesome days. So now you've missed 30 awesome days. And so now you're at negative 2.4% average annual return for 20 years. And so now you're left with $200. Oh, that sucks. It really sucks, but I'm going to do better. I am going to play around with it some more. Oh, you're going to do it. Why? but then you're going to play with some more, and now you miss 40 awesome investing days, and now you're at you're at negative 4.2% annual return, which really sucks because your $10,000 becomes $4,200. And then you say, you know what, financial dad, no, I'm really good. I know exactly what I'm doing, right? I screwed up 40 awesome days, but I'm gonna screw up another 10. And instead of having an annual return of 5.6% for 20 years, average, you're gonna have minus 5.9% average annual return. Not good. Not good. Just under $3,000 left after 20 years. And then you're like, okay, I'm all in. I'm so wicked smart. And now you're going to buy and you're going to sell and you're going to buy and you're going to sell and you try to time things. And then you realize you missed 60 of the best stock market days. And now instead of having $10,000, you're left with $2,100. And so what does this illustrate to you? What does that tell you? It tells you you shouldn't do anything. You should put your money in the index. You should leave it alone and just forget about it. The smartest person in the room is the person who's not doing anything at all. Okay, so I think this next part of the article is really important, right? It says, even if you think you'll wait it out for a few weeks to see what happens, as in you sell, be aware that 6 of S&P's 10 best performing days during the 20-year period occurred within 2 weeks of the 10 worst days. That's right. Just because you have crappy days, it doesn't mean you should sell because you're going to miss some of the best days that it rebounds. Okay, so what did we learn from this article? Don't do anything. Just don't touch it. Just don't touch it. And you'll be better off. And also the other thing that we learned is that some of the worst days that you'll ever have in the market also brings in some of the best days. And do you know when the best days gonna come? Do you know when the worst days are gonna come? So just don't touch it. Okay, so the second article, when you sell during a panic, you may miss the market's best days. This goes back to the first point that we talked about, this goes back to the second point we talked about in the first article, right? You just can't time things. You're going to say, financial dad, yeah, I can. And I'm going to look at you and say, no, you can't. And so this article really helps illustrate that if you, I almost said bad word, that if you mess around, it's not going to work out. So let's dive in. Okay, so the second paragraph is kind of interesting, right? It says, looking at data going back to 1930, Bank of America found that if an investor missed the S&P 500's 10 best days in each decade, total returns would be just 91%, significantly below the 14,962% return investors who held steady through the downturns. So what does that tell you? What does that tell you, Jimmy? But check this out. Check out this chart. Look how crazy this mood swing is. Woo, 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 woo. There's been some crazy changes going on. So on February 24th, you have a wild ride. You're going down 1,000 basis points. And then the next day, you go down some more, another almost 900. The 26th was okay, down a little bit. The 27th down the most, almost 1,200. But then check out March 2nd. Almost a historic day. It went up 1,300 points. Could you have predicted that? If you saw 5 crappy days, would you think, oh, hey, you know what? That 6th day is going to go up? Don't lie. March 3rd, it went down some more. And then March 4th, it went up again, almost another 1,200. Then March 5th, it went down another 1,000. But you know what? A lot of these, you see so many bars, right? So many bars going down and only 2 bars going up. And you're thinking, yeah, it was pretty bad. But overall, it actually gained. It gained. It actually was up 1.8%. So you can't tell, right? So you go boom, 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 and it goes back up, and it goes down a little, and it goes back up. And so really what it's trying to tell you is that you shouldn't try to time things. And this is this past month, right? Yeah, this actually happened. Did you do anything, Jimmy? Did you touch it? Okay, so basically early March, it's been in a correction, right? And so it's gone down 12% from its high. So anything more than 10 is in a correction. And so that's what's going on. And actually, surprisingly, It's pretty common. If you scroll to the article, you go down a little bit, it says basically on average since 1928, that's a long time. On average since 1928, there's been a correction once a year. So it's actually not that surprising that we're seeing some of this, but really what it's telling you is don't touch it, Jimmy. Okay, so really, I think what's awesome about these two articles is that it just illustrates that if you don't know what you're doing, but you're smart enough to buy an index fund that follows the S&P 500, then that's all you really need to do. You're actually pretty smart if you just buy that. You just buy it and you leave it alone. It doesn't matter if you're sitting on it for 20 years. It doesn't matter if you're going to sit on it since 1930 or something, right? Essentially is that you buy it and you forget it. Do you have time? Do you have time to track these things? I don't. I got 2 crazy kids running around. I got a business that I got to take care of. I don't have time for that. So I really enjoyed this article because it fits with my schedule. I wake up early, I go to work. I come back from work, I take care of my kids. I fall asleep with them because I put them to bed. So I don't have time researching on everything. And then it turns out it's great. If I buy an index and I don't have time to take care of it, I actually don't have to take care of it. So don't take care of it. So then you say to me, okay, Financial Dad, this all sounds really amazing. So well, actually, you haven't told us which index I should be buying to follow the S&P 500. So hold your horses. Here we go. So the 3 that I would recommend is stock ticker SPY, and that's from State Street Global Advisor. The other one is IBV from iShares, and also the last one is VOO from Vanguard. Okay, Financial Dad, thanks for sharing those 2 articles. Now, what are you going to do? Well, I'm here to tell you that as a small business owner, I've been saving a lot of money. I've been trying to save as much as I can, pretty much whenever I can. And it's for moments like this. I think that, yes, there's a correction, and then you keep hearing whispers that maybe there's going to be a recession. So a correction is when there's a 12% or 10% or more dip in all-time highs, but then recession is when there's 20%. So essentially, I think those are thresholds for when I want to invest. So as I see more corrections, I'm going to invest more. And then as I see more dips, and then when it goes into recession, I'm going to invest more, right? But I think one thing I want to point out is that I've also saved about 6 months of salary. I've saved money so that if something bad to really happen to my business, because I've never operated my business during recession, then I have that safety net. Some people, they don't need that safety net, but I do. I just find comfort in having that because I have kids. I don't really feel like I can skip a beat. And so that's what I'm doing. If there's a correction, I'm going to invest. If there's more correction, I'm going to invest more. And then I'm going to just hopefully use this opportunity to set my future and set up for a better opportunity, right? Investing now when things are going down will hopefully lead to a better future, right? And I think this is also really good because there's the illness out there, there's lots going on, and so people are fearful. So this is time to be greedy about it. And then you heard that saying, when people are greedy, then you should be fearful, right? So right now, lots of people are fearful, and so that's what I'm going to do. And really more importantly is that I have a dad joke for you now. Okay, I can already tell not a lot of you will like this dad joke, but I'm just gonna put it out there. And by a lot of you, really like not many of you. I haven't had a lot of people watch my videos. This is only my 2nd video. I have 1 subscriber, just 1. So I hope this 1 person likes this dad joke, and it goes like this. A furniture store keeps calling me. All I wanted was a one-night stand. You like it? You like it, my 1 subscriber? You like it? Okay, so I hope you enjoyed this episode. Episode 2 is really still relates to the illness that's going on. Again, I'm a small business owner, and so I'm going to talk a little bit about what I'm going to do in terms of my business and how how things might be affected as the illness goes around even more, and what I'm worried about, right? Because I have people who work with me that I have to take care of, that I feel responsible for. I also have my family that I feel responsible for. So for them financially, and then also health-wise, we have loved ones. So those are things that I'm going to tackle on my next episode. So see you for episode 3 of Financial Dad. Bye.